Every few years, the same story unfolds. Markets crash, jobs vanish, and millions lose their savings overnight. The 2008 financial meltdown, the dot-com bubble, the Great Depression, different decades, different technologies, but the same devastating pattern. Here's what nobody wants to admit. We know exactly why these disasters keep happening, yet we can't seem to stop them. The cycle of boom and bust has destroyed wealth and ruined lives for centuries, and right now, we might be closer to the next collapse than most people realize. Understanding why economic crises always return isn't just academic. It could save your financial future. Picture this. It's 2006 and everyone around you is buying houses they can't afford, convinced that real estate prices will climb forever. Fast forward 2 years, and the global economy is in free fall. Banks are collapsing, and millions are losing everything. Sound familiar? It should, because this exact scenario has played out dozens of times throughout history, just with different players and different assets. From the Dutch tulip mania of 1637 to the roaring 20s crash to the 2008 financial crisis, humanity seems trapped in an endless loop of economic euphoria followed by devastating collapse. The question that haunts economists, policymakers, and everyday people is simple yet profound. If we know these crises are coming, why can't we prevent them? The answer reveals something uncomfortable about human nature, market dynamics, and the very structure of our economic system. Economic crises aren't bugs in the system. They're features built into the fundamental mechanics of how modern capitalism operates. Today, we're going to dive deep into the real reasons why economic crises keep returning, stripping away the comfortable myths and facing the harsh realities that drive these cycles. We'll explore how debt becomes a ticking time bomb, why central banks can't save us, how psychological factors override rational decision-making, and what historical patterns tell us about where we're headed next. By the end, you'll understand not just why crashes happen, but why they're inevitable, and what that means for your money, your job, and your future. Before we dive into the heart of this crisis cycle, I want to hear from you. Drop a comment below and tell me, do you think we're heading toward another major economic crisis, or have we finally learned from past mistakes? Have you or your family been affected by previous crashes? Your perspective matters, and I read every single comment. If you're finding this valuable, smash that like button. It helps more people discover this crucial information. And if you want to stay ahead of economic trends and understand what's really happening with your money, hit subscribe and turn on notifications. Now, let's get into why these crises keep destroying wealth generation after generation. The debt engine and the illusion of endless growth. At the core of every economic crisis lies a simple but devastating truth. Modern economies run on debt, and debt eventually demands payment. To understand why crises always return, you first need to grasp how our entire economic system is built on borrowed money and the dangerous assumption that growth will continue forever. Let's start with how expansion phases actually work. When times are good, interest rates are typically low, making borrowing cheap. Businesses take out loans to expand operations, confident that future profits will easily cover the debt. Consumers finance homes, cars, and lifestyles on credit, convinced their incomes will keep rising. Banks, seeing profits in every loan, lower their lending standards and create increasingly complex financial products to multiply their returns. Everyone's making money, confidence is soaring, and anyone warning about excessive debt is dismissed as a pessimist who doesn't understand the new economy. This isn't theoretical. It's exactly what happened before every major crisis. In the 1920s, investors bought stocks on margin, borrowing up to 90% of the purchase price. When the market crashed in 1929, those debts vaporized wealth instantly. In the 1980s, savings and loan institutions made reckless real estate loans, leading to a crisis that cost taxpayers over $130 billion. In the early 2000s, subprime mortgages and derivatives built a house of cards that collapsed spectacularly in 2008. Here's what makes this pattern so insidious. Debt creates a false sense of prosperity. When you can borrow money, you can spend beyond your actual means, and that spending becomes someone else's income. A construction worker builds homes financed by mortgages. The worker spends his paycheck at local businesses. Those businesses hire more employees. Those employees get car loans and credit cards. The whole economy seems to be thriving, but it's actually building on a foundation of IOUs that will eventually come due. The mathematics of debt are unforgiving. When you borrow money, you're pulling future consumption into the present. That works beautifully during expansion. You get to enjoy things now and pay later. But eventually, later arrives. And suddenly, instead of borrowing and spending, you're paying back and cutting expenses. When one person does this, it's manageable. When millions do it simultaneously, it's a recession. What's worse is that our entire system is designed to encourage this cycle. Banks make money by lending, so they have every incentive to push loans during good times. Politicians face election pressures that reward short-term growth over long-term stability, so they encourage policies that juice the economy now. Consequences be damned. Financial regulators are often staffed by people from the very industries they're supposed to oversee, creating conflicts of interest that lead to lax enforcement. And everyday people, watching their neighbors get rich on borrowed money, feel compelled to join in or be left behind. The leverage ratios tell the story. Before the 2008 crisis, major investment banks were operating with leverage ratios of 30.1 or higher, meaning they had $30 of assets for every $1 of actual capital. When those assets dropped in value by just 3%, their entire capital base was wiped out. This wasn't an accident or an oversight. It was the logical outcome of a system that rewards risk-taking and punishes caution during boom times. Consider the total debt levels across different sectors. U.S. household debt reached $17 trillion by 2024. Corporate debt exceeded $11 trillion. Government debt topped $34 trillion. These aren't just big numbers. They represent claims on future production, future income, future wealth that may never materialize. Every dollar of this debt requires interest payments, principal repayment, and ultimately comes from someone's productivity. When growth slows or stops, these obligations don't disappear. They become anchors dragging the economy down. The illusion of endless growth is perhaps the most dangerous myth in modern economics. We've convinced ourselves that because we've had growth for decades, growth is guaranteed. But history shows something different. Growth is cyclical, debt is cumulative, and eventually, the weight of accumulated obligations overwhelms the system's capacity to service them. When that breaking point arrives, crisis isn't just likely, it's inevitable. The only question is timing. The psychology of bubbles and the madness of crowds. Understanding the financial mechanics of crises is only half the picture. The other half, arguably the more important half, is human psychology. Economic cycles persist because they're driven not just by mathematical inevitabilities, but by predictable patterns in how humans think, feel, and make decisions about money. Every bubble begins with a kernel of truth. In the late 1990s, the internet really was revolutionary. In the mid-2000s, homeownership really was expanding, and real estate had historically been a solid investment. In the 1600s, tulips really were exotic and beautiful. The problem isn't the initial spark of value, it's what happens next in the human mind. Psychologists have identified several cognitive biases that fuel economic bubbles, and they appear in every crisis without fail. First is recency bias, the tendency to assume recent trends will continue indefinitely. If housing prices have risen for 5 straight years, people unconsciously assume they'll keep rising, even though history clearly shows all trends eventually reverse. During the dot-com bubble, investors genuinely believed internet companies didn't need profits because this time is different. They weren't lying or stupid. Their brains were simply giving more weight to recent experience than to historical patterns. Then there's herd mentality, one of the most powerful forces in markets. Humans are social creatures who look to others for cues about correct behavior. When you see your neighbors, colleagues, and friends getting rich from an investment, the psychological pressure to join in becomes almost unbearable. FOMO, fear of missing out, isn't just a modern social media phenomenon. It's an ancient survival instinct that drives people to follow the crowd even when rational analysis would suggest caution. Nobody wants to be the fool who missed out on easy money. Confirmation bias amplifies these effects. Once you've invested in something, your brain actively seeks information that confirms you made the right decision while dismissing or rationalizing away warning signs. During the housing bubble, people who had bought overpriced homes convinced themselves that rising immigration, limited land, or new lending technologies meant prices could never fall significantly. They weren't evil or corrupt. They were just human, falling prey to the same mental traps that have caught people for centuries. The disposition effect, the tendency to hold losing investments too long while selling winners too quickly, creates additional instability. When markets start declining, investors hold on, convinced the downturn is temporary, which delays necessary corrections and makes the eventual crash worse. Then, when panic finally sets in, Everyone tries to sell simultaneously, creating the very collapse they feared. Perhaps most importantly, there's the illusion of control and overconfidence. During boom times, people attribute success to their own skill rather than favorable conditions. Real estate flippers in 2006 thought they were brilliant investors when really they were just riding a bubble. Day traders in 1999 thought they'd mastered the market when they'd actually just been lucky. This overconfidence leads to excessive risk-taking, more leverage, bigger bets, riskier investments, precisely when caution would be prudent. Financial markets have a peculiar feature that amplifies these psychological tendencies. They're reflexive, meaning that beliefs about them affect their reality. If everyone believes housing prices will rise, they buy more houses, which drives prices up, which confirms the belief, which drives more buying. This self-reinforcing cycle can continue far beyond what fundamentals justify, creating massive distortions that eventually snap back with devastating force. The emotional cycle of bubbles is remarkably consistent. It starts with displacement, some genuine change or innovation. Then comes boom as early adopters profit and others notice. Euphoria follows as profits accelerate, and caution is abandoned. This leads to profit-taking by smart money, who sense overvaluation. Then comes panic as prices fall and investors rush for the exits. Finally, revulsion sets in as the asset class is completely rejected and prices undershoot fundamental value. What's fascinating is that knowing about these psychological patterns doesn't protect you from them. Even professional investors and economists who understand bubble dynamics get swept up because the social and financial pressures are so intense. When all your peers are making money and you're sitting on the sidelines, the psychological pain is enormous. When you're watching your portfolio shrink daily during a crash, the fear is paralyzing. The madness of crowds isn't a bug in human psychology that we can fix. It's a feature that's been with us for our entire existence as a species. As long as humans make economic decisions, these patterns will repeat. The central bank trap and policy failures. Governments and central banks are supposed to be the adults in the room, using fiscal and monetary policy to smooth out economic cycles and prevent crises. In reality, they're often the biggest contributors to the boom-bust pattern, locked in a trap of their own making that makes each crisis more severe than the last. Let's start with how monetary policy is supposed to work in theory. During good times, central banks raise interest rates to cool the economy and prevent overheating. During downturns, they cut rates to encourage borrowing and stimulate growth. It sounds simple, but in practice, it's a disaster waiting to happen for several reasons. First is the timing problem. Economic data is backward-looking and often revised months or years later, meaning policymakers are essentially driving while looking in the rearview mirror. By the time they recognize a bubble forming, it's already so large that raising rates could trigger the very crash they're trying to prevent. And by the time they recognize a recession starting, it may already be deep enough that rate cuts are too little, too late. But the bigger problem is political and institutional pressure to keep the party going. Nobody gets rewarded for preventing a crisis that never visibly materializes. The central banker who raises rates during an expansion faces immediate criticism. You're killing jobs. You're harming growth. Why are you taking away the punch bowl when the party's just getting started? Meanwhile, the economic pain is real and immediate, while the hypothetical crisis they're preventing is invisible and uncertain. The political incentives all push toward keeping rates low and letting good times roll. This creates what economists call moral hazard, when people take excessive risks because they expect to be bailed out. Since the 1980s, central banks have consistently stepped in to rescue markets during downturns. The savings and loan crisis, the 1998 long-term capital management collapse, the dot-com bust, and especially the 2008 financial crisis all saw massive interventions. Investors learned a lesson, but not the one policymakers intended. Take big risks during booms because the Fed will save you during busts. The 2008 response exemplified this trap. Faced with financial Armageddon, the Federal Reserve dropped interest rates to essentially zero and created trillions of dollars through quantitative easing. These actions arguably prevented a second Great Depression, but they also had unintended consequences. They inflated asset prices to new highs, making wealthy investors richer while doing little for average workers. They encouraged companies to borrow cheap money for stock buybacks rather than productive investment, and they set a precedent that markets now expect to be repeated whenever trouble appears. This brings us to the current predicament. Interest rates were kept near zero from 2008 until 2022. an unprecedented period of extraordinarily loose monetary policy. This fueled massive increases in asset prices, from stocks to real estate to cryptocurrency, while also enabling companies and governments to accumulate record levels of debt. When inflation finally forced the Fed to raise rates rapidly in 2022-2023, the entire structure built on cheap money became unstable. Fiscal policy has its own problems. Politicians face constant pressure to spend money on popular programs and cut taxes, creating chronic budget deficits even during good times. When recession hits, governments add crisis spending on top of already large deficits, exploding debt levels. Eventually, this debt accumulation constrains future policy options. But by then, the politicians who created the problem have usually moved on. The European sovereign debt crisis demonstrated this dynamic perfectly. Countries like Greece and Spain spent lavishly during boom years, ran up enormous debts, and then found themselves unable to respond when crisis hit because bond markets wouldn't lend to them at affordable rates. The result was brutal austerity that deepened recessions and caused widespread suffering. There's also the problem of policy lag, the time between when action is taken and when it affects the economy. By the time central bank rate changes work their way through the system, conditions may have changed completely, turning yesterday's medicine into today's poison. The Fed's aggressive rate hikes to fight inflation, for instance, didn't immediately cool the economy. They took months to work, during which policymakers worried they'd done too much or too little, often both simultaneously. Perhaps most troublingly, each crisis response has required more extreme measures than the last, suggesting diminishing returns and growing fragility. The system becomes addicted to stimulus, requiring ever larger doses to achieve the same effect, while the underlying structural problems remain unaddressed. Historical patterns and what they tell us about the future. History doesn't repeat itself, but it definitely rhymes. When you study economic crises across centuries and continents, certain patterns emerge with striking consistency. Patterns that should terrify anyone paying attention to current conditions, because many warning signs are flashing red right now. The anatomy of historical crises reveals a common structure. It begins with financial innovation, something new that promises to revolutionize how we think about money, risk, or value. In the 1600s, it was joint stock companies making tulip speculation possible. In the 1920s, it was buying stocks on margin. In the 2000s, it was mortgage-backed securities and collateralized debt obligations. These innovations initially provide real value and efficiency, which attracts capital and attention. Next comes the democratization of access. The innovation that started with sophisticated investors spreads to the general public. Before the 1929 crash, small investors were buying stocks for the first time. Before 2008, subprime borrowers were getting mortgages previously reserved for creditworthy customers. This broadening participation accelerates price increases while simultaneously lowering the quality of underlying fundamentals. Then there's the phase where warnings are dismissed. In every single bubble, there are voices pointing out that valuations have become disconnected from reality. Before the Great Depression, economists warned about excessive speculation. Before the dot-com crash, traditional value investors highlighted that internet companies with no profits couldn't possibly justify their stock prices. Before the housing crisis, analysts noted that home prices had diverged dramatically from historical relationships with incomes and rents. These warnings are always ignored or ridiculed during the boom because, well, everyone's making money, so obviously the warnings are wrong. The trigger that finally pops the bubble varies, but the aftermath follows a predictable pattern. First comes denial, a brief period where most people insist it's just a temporary correction. Then comes panic as the reality of losses sets in. Financial contagion spreads as interconnections between institutions become apparent. Credit freezes as lenders become terrified of default. The real economy suffers as spending collapses and unemployment soars. Eventually, after tremendous pain, markets bottom out and recovery slowly begins, setting the stage for the next cycle. What's particularly instructive is comparing the severity and spacing of crises over time. Major financial crises occurred roughly every 20-30 years through most of history. The Panic of 1837, the Panic of 1873, the Panic of 1893, the crash of 1929. But since deregulation accelerated in the 1980s and central bank intervention became more aggressive, we've seen major crises in 1987, 1998, 2000, and 2008. They're getting more frequent and more severe, despite our supposedly superior economic understanding and tools. This acceleration suggests we're not learning from history. we're repeating it faster. Each crisis response creates conditions for the next crisis. The savings and loan bailout taught Wall Street that risky bets would be rescued. The Fed's response to the dot-com bust inflated the housing bubble. The response to 2008 has inflated everything bubbles in stocks, bonds, real estate, and alternative assets simultaneously. Looking at current conditions through the lens of historical patterns should give everyone pause. Corporate debt is at record levels. Government debt has exploded beyond anything in peacetime history. Asset prices have been inflated by years of zero interest rates and quantitative easing. Income inequality is at levels not seen since just before the Great Depression. Consumer confidence remains fragile despite apparent economic strength. Housing affordability is worse than at the peak of the 2000s bubble in many markets. The triggers for the next crisis are impossible to predict with precision. They always are. Maybe it's commercial real estate, where vacancy rates are soaring as remote work empties office buildings, while massive loans come due at much higher interest rates. Maybe it's a sovereign debt crisis as countries struggle to service bonds issued when rates were zero. Maybe it's something in the shadow banking system, private credit funds, cryptocurrency exchanges, or other lightly regulated financial institutions that have grown massive during the era of cheap money. What history teaches unambiguously is that the crisis will come. The exact timing and specific trigger may be uncertain, but the destination is clear because the fundamental dynamics, excessive debt, psychological biases, policy errors, and reflexive market feedback loops remain unchanged. Each boom plants the seeds of the next bust, and each rescue operation creates the conditions for the next crisis. Until we fundamentally restructure how our economic system operates, this cycle will continue, destroying wealth and causing suffering generation after generation, always surprising people who somehow believed that this time would be different.